I think this cycle is going to be much longer than people think. I definitely don't think this pullback is the end. I think 2025 will be a great year. I think 2026 will be a great year. I think 2027 will be a great year. And we'll see about 2028.
4-year cycle? Is it over?
Yeah.
Woo.
It's over.
Okay, hold on. Explain.
Matt Hougan begins with a powerful psychological insight. The biggest barrier for many investors wasn't volatility, it was the fear of Bitcoin going to zero. Unlike losses from volatility, which investors are trained to accept, losing everything and looking foolish was a bridge too far. But according to Hougan, that risk is now gone.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I think the percentage of the real reason people didn't invest before the ETF, before the election, was this thing in the back of their mind that said this thing might go to zero. And investors are comfortable with investments that go up and down. They're actually comfortable with losing money, but they're not comfortable with looking foolish and buying something that goes to zero. And I think we just completely eliminated that left tail. There's the Bitcoin obituaries site, which cites the number of times the media says Bitcoin is going to die. I think it's like 1,200 or something. It basically hasn't had one in the last 18 months. So I think that was also a big change. Everybody is buying the ETF. The ETF is an incredible deal. Our ETF charges 20 basis points. You have to be managing billions of dollars in Bitcoin to get that kind of deal with, audit and custody and all those bits and pieces. So it's retail is buying ETFs. It's hedge funds are buying ETFs for the basis trade. It's RIAs buying ETFs. It's family offices buying ETFs. It really has become the primary tool for everyone. The only thing I would say about that is, we're going to see more people buying ETFs next year. I think flows this year will outpace flows last year by a significant fraction. So if you thought last year was good, just wait. I mean, we think the US is an enormous growth market because you're really penetrating that wealth market. And the wealth channel, when you get into Europe, is very different. It's more sort of bifurcated there with significant retail interest and then a lot of hedge fund interest. But interest is growing around the world. They're just each one is its own different market. I do continue to think U.S. wealth is where the next, 100, 200, 300 billion dollars of inflows come. But there's significant growth in Europe as well.
4-year cycle? Is it over?
Yeah.
Woo.
It's over.
Okay, hold on. Explain.
Well, I mean, so my view of the 4-year cycle is you have a catalyst that brings new pools of capital in. So 2011, it was the launch of Coinbase. Retail investors could buy Bitcoin, new capital, then leverage builds up and eventually it pops. 2015, the introduction of Ethereum. 2019, DeFi. 2023, it was Grayscale winning its lawsuit in March against the SEC. We're going to get ETFs bringing in capital. The reason I think it's probably not going to play out over 4 years is I think that's a longer inflow of capital than retail hot ball of money, which was the past 3. And then secondly, we have yet another of those catalysts in November, which is the election completely changing the game in terms of institutional adoption. So even if the ETF-driven cycle would have built up, leveraged, and popped and receded, we have this second tidal wave that's just so much bigger than that first one. It's going to overwhelm it. So will there be, pullbacks? We're seeing one now as leverage comes out of the system, of course. But the election was such a sea change that it's like, it doesn't matter. Yes, there may be this natural thing, but it's just going to get bulldozed over. That doesn't mean we've repealed pullbacks, but I think this cycle is going to be much longer than people think. I definitely don't think this pullback is the end. I think 2025 will be a great year. I think 2026 will be a great year. I think 2027 will be a great year. And we'll see about 2028. Retail is in this very sad place right now. Institutions are completely oblivious to that. Like, it is only the best time ever in crypto if you're an institutional investor. They're not talking about Bybit or meme coins. They're talking about the ETF launching. They're talking about the election change. They're talking about the SEC removing lawsuit after lawsuit against the crypto industry. So I think there is this two very different time frames in crypto. Institutions are moving on a multi-year time frame, and the multi-year story for Bitcoin is just the best it's ever been. I'm not sure. Yeah, maybe we saw retail and institutional agree a little bit at the start of the Bitcoin ETF launch, but not right now. Retail is sad, institutions are bullish, and in this case, institutions are right. If you look at the gold market, for instance, that's what you see. People own gold ETFs and they own gold bars. The same thing is going to be true here in crypto. So I think it's probably more likely that more sovereigns are going direct, but you'll definitely see more than one take the ETP route. It's just incredibly convenient, incredibly low cost, and allows you to execute very quickly without having to set up the custody side of the business.
For some clients, Bitwise is the BlackRock of crypto. But for others, Bitwise's crypto-only focus is what makes it trustworthy. 100 professionals, no distractions, full-time crypto. That, Hougan says, is what resonates. He also notes increasing demand for yield strategies. Bitwise recently launched a separately managed account for an institution that wanted derivatives-based yield on top of their existing Bitcoin position, a sign that we're entering a more sophisticated era of crypto finance.
Yeah, I think you have to think of it as a spectrum, right? From RIAs, which are independent people, up to the largest wirehouses, the Morgan Stanleys, et cetera. The RIAs have started coming in already. That's going to be 2.5% to 5%. I think you're going to see those numbers creep up from where BlackRock sort of introduced them today. I think we're going to end up at 2.5% to 5%. As you move up the spectrum to national banks and regional wirehouses, those have mostly flipped. I forget, Hunter, how many platform approvals we have, but it's a very large number. What we're waiting is for the sort of 4 big wirehouses to fall. And it's anyone's guess, when that will happen. Just to give an anecdote that points in the direction, we do tours through the middle of the country to talk to them every year. A few years ago, you'd go and do a meeting. It'd be 2 junior guys. I was out there last month. It was 12 of the most senior people, and there were actually 2 meetings at the same time. It's a game changer. I introduced that to say that will happen soon too, right? So I know crypto is uncomfortable with how slow it is, but it's happening. Look at the 13F filings, which count the amount of Bitcoin assets. It went from 17 to 28% of Bitcoin AUM from Q3 to Q4. That's going to be 40 or 50 by the end of this year. So this train is moving, and it's gathering speed.
I think BlackRock is very satisfied with the result. We're grateful to be one of the largest, and as you said, a lot of great firms. I think that for many of our clients, so it depends a little bit. I think for individuals, they oftentimes will invest with us because they see that we publish the public wallet addresses of the Bitcoin held by the ETF, and they see that we want to bring the fundamental characteristics and value of Bitcoin into the traditional system and not to forget about what made Bitcoin important in the first place and just hand the dollars over to Wall Street. We donated last week to open source Bitcoin developers. This week we sponsored a community space in San Francisco for Bitcoin developers. And so I think there's a lot of people in the community who say, we're excited for Bitcoin to enter the mainstream, but we don't want to lose its soul. And we trust that Bitwise will try to retain those things. And so we like the ETF for that reason. Amongst investment professionals, I think that there are a lot of investment professionals who are used to in credit. Some of them will invest in BlackRock's credit fund, and some of them will invest with Ares. And in private equity, some of them will invest in BlackRock's private equity fund, and some of them will invest with TPG, Carlyle, KKR. And I think that for a lot of our clients, the idea that we have 100 professionals who are only focused on this space and don't have other things competing for our time, and that they can pick up the phone and call us at any point, and we're there to help them, I think that resonates. Another thing that is emerging is that many of our clients are interested in doing additional things. So we've been getting more questions recently about, can you help us earn yield on our Bitcoin? So for one very large institutional client, we just set up a separately managed account where we run a derivative strategy on top of their Bitcoin position. from the custodian where they currently hold their Bitcoin. And so I think the second thing that some of our clients like about working with us is the feeling that we will support what they want to do in the space more broadly, that we're a partner to them on accessing the opportunities versus sort of only having one thing. So I think those are the reasons that the clients will sometimes choose us, and we're really grateful that they do. The analogy that comes to mind for me recently, and I'm already being long-winded with this answer, but if you think back to the early days of Facebook, if you can rewind your memory a little bit, before Facebook IPO'd, it was a thing that maybe you used or one of your friends used, and you heard about Facebook, and you heard about this crazy CEO who was some college dropout, and it was a social phenomenon, but it wasn't an investment decision for you. You couldn't invest in Facebook stock. You didn't have to decide if $35 was a high price or a low price. And I think for a lot of investors and a lot of our clients, that's what Bitcoin felt like for a very long time, is this social phenomenon. You had friends or family who were doing something with it, had some opinions about it, good, bad, whatever. And then the Bitcoin ETFs were like the IPO. Like when Facebook went public and it was trading at $35 a share, and you could decide if that was the investment opportunity of a lifetime or a wildly overvalued, unprofitable startup. But suddenly it was something for you to consider about Facebook that you hadn't considered before. And I think that the Bitcoin ETFs were that moment for a lot of investors who couldn't use the Coinbase app or invest any other way, the first time that they could really consider Bitcoin as part of the opportunity for them. So I think that really fundamentally changed the set of audiences that could participate.
In perhaps his most powerful metaphor, Hougan compares Bitcoin's evolution to Facebook's early days. Before the IPO, Facebook was a cultural phenomenon, but you couldn't invest in it. Once it went public, suddenly it became a legitimate investment decision. Bitcoin ETF, he says, are Bitcoin's IPO moment. For years it was something you heard about. Now it's something you can own through a familiar and regulated investment vehicle. Please like and subscribe.